afternoon, everyone. Good afternoon, and welcome to COL Conversations, our webinar series that brings you closer to the leaders of different businesses and known experts in markets and investing. I'm Marvin Fausto, President of COL Investment Management. Welcome. In this conversation, we invited the leaders of Ayala Land and AREIT to find out what are the latest updates regarding these companies. We actually invited them both for investors to have a more holistic view of the real estate business of the group, since they have a lot of synergies between the two companies. We will try to find out why ALI and AREIT remain solid investments despite the market's volatility. Allow me to introduce the people behind Ayala Land and AREIT. First, Mr. Augusto D. Bengzon, Toti for short, has been with ALI for the past 18 years and is currently the Senior Vice President, Chief Finance Officer, and Treasurer of Ayala Land. He is also a Director of AREIT and Treasurer of ALL-HC. He sits as Director and Treasurer of a lot of Ayala Land property and subsidiaries. So if there's a person who knows the finances of the group, it's Mr. Toti Bengzon. So Toti Bengzon, thank you for joining us. Now, representing AREIT is Ms. Carol Torres Mills, President and CEO of AREIT Incorporated. She is also Vice President of Ayala Land Inc., heading their office leasing and development. She headed the business and project development for Ayala Malls. She has been with the group for 24 years, holding various board positions in several Ayala Land property and subsidiary companies. So let's also welcome Ms. Carol Mills. Thank you, Toti and Carol, for joining us.
Glad to be here, Marvin. Thank you for inviting.
Thank you, Marvin.
Okay, so let's move on with our webinar series now, where we have programmed with the presentation of first on Ayala Land. Will be presented by Mr. Toti Bengzon, and then right after, soon after, we will have the presentation of Ms. Carol Mills on AREIT. So, okay, the floor is yours, Toti.
Good afternoon to all the COL clients. Thank you, Marvin and the team for inviting us to share the Ayala Land and AREIT story. And I thought I'd do something a little bit different this afternoon because I've been a guest on your show for the past 2 years. And I, rather than just talking about the results, the financial results of the company, which we disclosed to the public last August 5, and which Richard has already written about, I thought I'd give another perspective on the Ayala Land story. And this is, I guess I'd like to start off with what drives the growth of the company. So my key messages this afternoon would be, the first is, it's the country's solid macroeconomic factors that are driving the performance of Ayala Land. Real estate is a very localized industry, and to a large extent, it's dependent on how the country's economic performance, A second, particular to Ayala Land, is we do have a strong balance sheet that has enabled us to weather the COVID pandemic and the economic scarring that has occurred in the past 2 years. And it's the same balance sheet that will allow us to recover and get back to where we were pre-pandemic. And third, I just wanted to also talk about what enables us to grow and what differentiates Ayala Land from other property developers, not just in the Philippines, but I would say in the world. And that is the fact that we build estates, which are large-scale, mixed-use, integrated communities. We have the largest land bank and the integrated ESG practices that enable us to build these sustainable communities and contribute to the country's economic progress. So with that, let me start with the macroeconomic factors that drive not just Ayala, but all businesses in the Philippines. But I just wanted to focus on three macro factors that we've been tracking in the Philippines and which are very supportive of our various businesses. First is GDP growth. This is quite important, and our objective in the company is to grow faster than GDP. So we'd like to aspire for growth that's 1.5 to 2 times faster than GDP growth. And we've seen over the past decade how the economy has been growing at, let's say, 5-6% clip. And part and parcel of GDP growth would be the contribution from household consumption. It accounts for about 60 to 70% of GDP. And these factors, or this feeds directly into our malls businesses, our hotels and resorts businesses. The second economic indicator that we closely track would be OFW remittances. And we know the story. OFW remittances continue to grow. This year, it's forecasted to grow about 4%. And as you know, these remittances feed straight into our economy, particularly in our case, into our residential businesses. And third would be BPO revenues. This has been a sunrise industry. And this has been growing at previously at a double-digit clip. The next couple of years, we think it'll still be growing, albeit at a more modest mid-single-digit clip. But it has contributed significantly to the economy. Last year, close to 30 billion in revenues. And more importantly, it has been contributing to job creation in the country. Now, the BPO industry feeds straight into our office portfolio. We are now the largest office landlord in the Philippines with over 1.3 million square meters of gross leasable space. I would say, and Carol will talk more about this, close to 60 to 70% of our portfolio is leased by BPOs. We have a new administration in place, and we've been looking at the economic programs of the government. And first and foremost, where I believe the business community is quite pleased with the appointments to the finance sector, finance secretary, the BSP governor, the budget secretary, all seasoned hands, well known to the business community, and we believe we'll be pursuing policies and programs that will continue to be supportive of a growing economy. We're quite keen to see what GDP will be like this year. Our sense is, I guess, similar to what the forecasts you see on the lower left-hand side of this chart show, anywhere in between 5 to, I think it's probably going to be more, it's going to be closer to anywhere in between 6 to 7.5%. And that would be a very good number for the country. More importantly is the prognosis for the future. I think what we've seen is the households have become more wealthy, and by 2024, there is a forecast that we will achieve the upper middle status globally. What that means is we'll see our per capita GDP approximately at the $4,000 per capita level. I also read recently that there's a, if things go right for the country, we will possibly be a high income economy by 2050. But all of that is based on the economy growing at a 5-6% clip, which so far we've seen that in the past decade, and in this administration, it's a target to be growing at that level. This last slide on the macro indicator shows what a growing economy can do to the population. And we're basing this on the 2018 Family Income and Expenditure Survey. Just this morning, I read that the 2021 survey has come out. Once it's out, we're gonna update these slides. And I understand that from the previous 3-year cycle, they're going to make it a survey that repeats every 2 years. But what we have, the latest figures we've got here is 2018. And what is interesting here is how the lowest economic segment has been reduced from 54% to 47%. And you see that the C class has increased from 40% to 45%, and the B class from 6 to 7%. And what this shows is that there's more purchasing power. You're seeing a growing middle class. And this is what we all want to see in this country. We want to see poverty levels reduced. What we've done in Ayala land is we've successively established residential brands that cater to all the socioeconomic segments in the country. Previously, we were known to be a residential company for the premier segment, or the high-end segment. But as you can see from this chart, we now have brands that cater to the middle income as well as the socialized segment. We're also keen to see that this administration aims to cut the poverty rate by 9%, and that by 2030, our middle income population should grow to 37.5 million, making it the 4th largest in the world. I think these are all good indicators to show that we have a population that's becoming more prosperous. We are believers in urbanization. The slide on the lower right-hand side shows that urbanization has continuously increased. Even during the pandemic, when people said people would migrate away from the cities and into suburban areas, we were believers that once the pandemic is resolved, people will go back into the cities. And we're seeing that today. And with urbanization comes a greater increase in the incomes of the greater population. So with that, let me move on to our balance sheet. We've made sure, or let me start first with our performance highlights, the first half. And the takeaway from this slide is just that you've seen sequential growth in our financials. So first half revenues were up 9%, but in the second quarter alone, it was up 18% year on year. And on a quarter on quarter, it was growing by 17%. It grew by 17%. For net income, first half was up 34% from a year ago. The second quarter number was 51% higher than the second quarter of 2021. And on a quarter on quarter basis, it grew by 55%. On our property development revenues, a similar story, sequential growth. First half, property development revenues were up or flat, 34.1 billion, flat versus the first half of 2021. But in the second quarter, it grew 2% versus a year ago level. And on a quarter on quarter basis, it was up by 15%. Sales reservations, which is a leading indicator for our residential business. First half numbers up 2% from the prior year at 49.3 billion. In the second quarter, 25.2 billion, up 28% from a year ago level. The recovery is more marked in the commercial leasing segment. The first half, it was up 54% year on year. Second quarter, 87% year on year. And this is really an offshoot or a result of the increased mobility that we're seeing. Since in the second quarter, the quarantine restrictions were lowered. We're now at alert level 1. And I understand that the president has pronounced that he doesn't want to see any more lockdowns. And the result of these pronouncements is that you see greater mobility. And in our malls, in the second quarter, average foot traffic was already at 87% of pre-COVID. In June, it's at 93%. And in July, it's already back to pre-pandemic levels. Similarly, tenant sales have started to recover. In the second quarter, it was at 82% of pre-COVID. In June of this year, 89%. And I'm sure it's increased leading into the Christmas season. I'm confident that we'll see tenant sales back to pre-COVID levels, if not exceeding. Our balance sheet remains strong. Net gearing ratios, our net gearing ratios remains at 0.77. And we've locked in all our funding requirements for the year. We did the jumbo bond issue, the largest ever, last July 4. And after that issuance, 99% of our debt is now on a long-term basis and 98% of it is fixed. So that puts us in a good position as interest rates start to increase or creep up. We are first and foremost a developer of estates, large-scale, mixed-use, integrated communities. And this is the differentiating factor for Ayala Land. We have 47 estates across the country, 30 of which are integrated mixed-use estates, like what you see in Makati and BGC. We have 2 tourism estates in El Nido and in Sicogon, 5 commercial estates, 5 residential estates, and 5 industrial estates, primarily under our other listed entity, Ayala Land Logistics Holdings Corporation. With 12,498 hectares of land bank, we have the ability to launch more estates. And I think this is what differentiates us from the competition. With that land bank, we're able to launch more product and different types of product depending on where the demand is at. We've got a balanced set of businesses. We are a fully integrated real estate developer. As you can see, we've got 5 brands on the residential side. We've got malls, offices, and hotels and resorts for our leasing businesses. We've got factory buildings and warehouses under All HC. And we've got our co-living and co-working spaces under the Flats and Clock-in brands. In addition to these, we've got our services businesses, which support our property development and leasing businesses. We have the largest construction company, MDC, the largest property management company, APMC, and our own airline that services our tourism estates. It's under Air Swift. We also have investments in, of course, AREIT, where we maintain a 66% stake. We have a small residential company in Malaysia, and we have got our investments in Ortigas. So this diversified portfolio of real estate businesses, together with the solid, strong balance sheet, will allow us to capture any upside growth opportunities. And it has enabled us to weather the pandemic and weather any unforeseen risks that may occur in the future. So I believe this is what makes Ayala Land unique. And to our final slide, it's this diversified portfolio and strong balance sheet that will allow us to capture opportunities, manage risks, protect stakeholder value, and deliver long-term earnings growth. And I just wanted also to end with the note that Richard put out for COL. And he's maintaining the buy rating on ALI, even though the fair value or net asset value, or even though I think the net asset value has been reduced a little bit, but he sees significant upside from, well, the current price has already moved. I understand. I think we're already at 30 pesos today. What I like is that he's got a balanced picture and he understands Ayala Land. He has cited that our earnings growth may be negatively affected by the challenges we face on the residential segment, and we acknowledge that. But he sees great value in Ayala Land, as we are the biggest developer of estate projects in the Philippines, and we continue to create value from our land bank through our superior master planning of our estate projects. So with that, I'll pass it on to back to you, Marvin, and on to probably you can introduce Carol.
Yes. very encouraging numbers. Very encouraging numbers so far, first half. And still massive land bank. And hopefully we see that monetized for the coming years as well. So thank you for that, Toti. So we'll have you later in the Q&A, the panel after Carol. So let's give the floor now to Ms. Carol Mills to present AREIT. Carol?
Thank you, Marvin. Thank you for inviting us this afternoon. Good afternoon to everyone. First of all, let me say that AREIT marked its second year anniversary as a REIT, actually last Saturday. And as I will be sharing later, I hope you can see how AREIT has consistently delivered on our commitment to provide investors stable and growing shareholder returns despite the challenges of the pandemic and macroeconomic volatility. And so today, I hope to demonstrate how investing in REITs can provide that resilience amidst market uncertainties. AREIT, the first Philippine REIT listed in 2020, adhered to 5 investment fundamentals: prime location and quality assets, stable occupancy with long-term contracts and quality locators, inflation hedge growth in income and dividends, track record in execution, and lastly, of course, the strength of our sponsor, which is Ayala Land. Current ownership is about 60% ALI and 40% public, with skin in the game for ALI as a sponsor of the REIT. Sizable market cap at over $100 million US or 56 billion pesos. Total portfolio size of about 549,000 square meters, coming only from 150,000 square meters when we listed. The chart here below shows the value of our assets that have grown significantly from 35 billion to 57 billion today, and revenues from 2 billion when we started in 2020 to 3 billion in 2021 and over 4.7 billion forecasted in 2022. We are also very pleased to have been recognized internationally, various awards, among others, Most Outstanding IPO, Best IPO, and Southeast Asia Deal of the Year from various international organizations. We started with just 4 assets when we listed, 3 in Makati and 1 in Cebu. But today we have 13 properties across the Philippines. In 2021, first year of our operations as a REIT, we acquired the 30th, that's commercial development in Pasig City, Meralco Avenue, as well as a 9.8 hectare land parcel in Laguna Technopark that's leased by IMI, which is also, as you know, a subsidiary of Ayala Corporation. And these 2 assets immediately added 7 billion in value to the company and contributed to our operations 4 months after we listed in August of 2020. In the same year, in 2021, we entered into a property for share swap with our sponsor, Ayala Land, involving commercial properties valued at 15.5 billion, all located within prime commercial districts in the country, and income for these properties accrued to AREIT fourth quarter of 2021. So in 2021, from a portfolio of 340,000 square meters and assets under management of 35 billion, we expanded to 549,000 square meters and assets under management of 53 billion pesos. This year in 2022, we continue to expand. The company has a plan to infuse another 124,000 square meters of prime office buildings in Cebu, valued at 11.3 billion, through another property for share swap. And once implemented, this will bring our total portfolio now to 673,000 or 673,000 square meters and or 64 billion in assets under management. As you very well know, next to Metro Manila, Cebu is the largest market for BPOs, with many global companies having it as a secondary location as they expand outside Metro Manila. So with these asset infusions, AREIT is on track to double its assets within 2 years from when we listed as a REIT. This addition of new assets has resulted to AREIT not just expanding by size and income contribution, but also in terms of diversifying our geographical presence, asset classes, and tenant mix, thereby overall minimizing the risk of the portfolio. AREIT locations, as mentioned earlier, we started just in Makati, but today we are present in 9 cities nationwide. Its portfolio, while predominantly offices, also has some retail, some hotel and industrial land. And their tenant locators vary from BPOs, traditional companies, retail, manufacturing, hospitality, etc. And with now a bigger number of tenants that we have in our portfolio, our tenant concentration risk is quite low, such that we don't have any one single tenant that we are exposed to by more than 10% of the portfolio. Now, in terms of financial performance, AREIT has significantly increased over the last 2 years. In 2021, the first year of operations, we recorded revenues of 3.3 billion, 63% increase from 2020 when we started. EBITDA, proxy to net operating income, is about 2.4 billion in 2021, 55% growth. So with net income, 56% growth, all within the first year of operations. And this financial performance was sustained further into the first half of 2022 with revenues at 2.36 billion for the first semester, 67% up versus last year. EBITDA of 1.7 billion, 62% up, and net income 1.61 billion, 64% increase over same period last year. And we expect to continue this for the balance of the year into next year with the full contribution of the Cebu assets in place. Our operations remain very stable with 97% occupancy, 98% rental rate, rental collection. Quarter-on-quarter revenues and income very regular and consistent. Lease expirations are minimal in the next 3 years. And since our weighted average lease expiry or WALE is quite long at 3 years for office and 5 years with other properties, we expect that continuity, stability, and consistency in income, which is important for the REIT. The company's balance sheet also remains very strong with low debt exposure. Not only does this minimize our exposure to high interest rates, but it also gives the company the ability to expand for future acquisitions. As a result of the company's stability and expansion, AREIT dividends have grown by 75% from 2 years ago since we listed. From when we started, our dividend was at 28 centavos per share. And today, our most recent dividend declaration last week was 49 centavos per share, which will be paid in September to stockholders of record on August 26. This dividend growth or DPU growth is a key investment consideration because it provides you, the investor, a hedge against inflation versus other fixed income instruments. All this dividend growth, expansion, stable operations resulted to AREIT outperforming the index over the last 2 years when we listed. AREIT share price remains significantly above IPO price with the highest total shareholder return to its investors. And with this performance, AREIT is included in several indices, increasing its visibility to even foreign investors and the like. So in summary, AREIT has always adhered to our core principles of being in prime location, having quality and long-term occupancy, contracting inflation hedge escalations, undertaking accretive acquisitions, and complementing all these by our sponsor's track record of management and execution. And we believe by consistently adhering to these basic principles, we believe we can rise above whatever short-term challenges we face and set our sights on long-term value. At this point, let me just step back a bit and provide some insights on how REIT investing can provide some resilience despite uncertainties. I won't go so much into discussing what a REIT is all about because I'm sure all of you are familiar, but I just wanted to emphasize what makes a REIT a unique investment instrument and therefore more resilient than that of other investment products. A REIT is a unique investment because it provides, it's really a hybrid between a fixed income like a bond and equity like stocks. So similar to bonds on the left-hand side, it gives that regular predictable income. At the same time, like stocks, it gives that potential for price appreciation. So the REIT is really a hybrid with that regular dividend and potential for price appreciation. Of course, critical to achieving this is the REIT's ability to deliver that stable income dependent on the quality of its assets, its tenancy, its contracted lease terms, and inflation hedge contracted escalations. While the potential for price appreciation is based on the company's ability to grow and expand over time. And for AREIT, this is exactly what we tried to deliver, a combination of yield like bonds and capital appreciation as we continue to focus on the long-term growth of the company. Globally, REITs have been around for decades, more than 60 years across 40 countries, and have withstood several financial crises. It has historically delivered competitive total returns from both regular dividends and capital appreciation. And for investors, many benefits such as liquidity. It is easily traded in the exchange. You're not locked in for long-term transparency with all the REIT disclosures required, tax incentives, lower tax on dividends, and zero tax for dividends for Filipino corporations. It also allows for portfolio diversification as a balance between fixed income and equity exposure, and depending on the exposure to the real estate asset class that the REIT holds. And again, inflation hedge as dividends can potentially grow over time. Of course, it promotes inclusiveness, allowing many smaller investors like us to own high-value commercial real estate with minimal upfront investment. But as they say, not all REITs are equal or the same. And so it's important for investors to really look into certain elements that make a REIT more resilient, especially when times are uncertain. One is market cap of the REIT. Size matters, and the larger the market cap, the more visible, liquid, and tradable it is in the exchange. Second is total shareholder return. REITs are not just about yield, but it's also total shareholder return, which is dividend yield plus growth. Third is stability. I mentioned earlier, occupancy is important. WALE or weighted average lease expiration, and the percentage of near-term lease expirations. The more locked in the contracts, the more stable the income of the REIT. And fourth, asset mix for risk diversification and exposure to different asset classes. And fifth, of course, is growth potential, and this can be assessed in many ways, such as the amount of sponsor assets that have already been injected to the REIT, relative to the sponsor's pipeline to feed future assets to the REIT. And perhaps leverage potential is also another measure of the REIT's ability to inject future assets. Now, one last point of resiliency that I also wanted to mention is related to the asset class that the REIT holds in terms of its portfolio. Because currently 5 out of 7 Philippine REITs hold office properties, and many, of course, have asked how resilient the Philippine office sector is. Toti mentioned this earlier, demand for office space in the Philippines is really driven by BPO over the last decade or even more, and BPOs have dramatically grown in the country from just simple call centers in the start of the millennium, 2000, early 2000, to all kinds of back office services and operations, customer service, tech support, HR administration, insurance, legal, healthcare, banking, accounting, e-commerce, travel. All of the largest global companies operate somehow via outsourcing, and this has also trickled down to mid-size companies across all types of sectors and businesses. And the Philippines is in a bright spot, it being the second largest destination for business process outsourcing. So demand for office space continued even during the height of the pandemic and will continue as global businesses will expand further. And the recent large vacancies in office buildings was not really because of BPOs contracting, but because of the flight of many POGOs who vacated spaces. Post-pandemic industry studies anticipate continued net take-up of office space despite some companies doing hybrid work. Office spaces did not become obsolete, but the use of office space has evolved to highly collaborative, interactive, flexible, and increased adoption of hub and spoke or satellite offices formats. And studies have shown that businesses will continue to expand, and with lower density requirements for office spaces, this would still result to a net increase in office take-up. So in summary, AREIT delivered on both yield and growth, sustained financial performance despite the challenges of the market, provided resilience, and even outperforming at a time of market uncertainty by adhering to its 5 key investment fundamentals focused on long-term growth. And on REITs as an investment instrument, it can provide benefits of both fixed income and equity capital appreciation potential. As long as certain elements of the REIT is in place, it can provide resilience during uncertain times. And finally, the office sector, which is currently a predominant asset class for Philippine REITs, today has exhibited resilience driven by the BPO market despite hybrid work arrangement. Thank you. That ends my presentation. Back to you, Marvin.
Yes, thank you very much. Yes, thanks, Carol. I'm happy to see that AREIT continues to grow, no? Almost, I mean, on the path to doubling this year. And I'm also happy to see the consistent growth in dividends every year, every quarter. Thank you very much.